The blackout on U.S. government data continues, with today's inflation report being postponed to later in the month. But amid a pickup in trade tensions, is this lack of timely reporting causing a risk to the markets and the economy? Joining us now to discuss is Hafiz Noordin, VP and Director of Active Fixed Income with TD Asset Management. Great to have you back on the program.
It's great to be here.
All right, obviously we plan these shows in advance. We say if we're going to have an inflation report, we're going to have Hafiz Noordin on the show. Obviously, by forces greater than ours, we don't have one. How do you navigate this environment with this timely, data being denied us?
Yeah. I mean, it's unfortunate we don't have the real data in hand, but I think it's always important to not just focus on 1 month of data. And I think the way to think about this as an investor is to, first of all, think about what's the broader trend in inflation in U.S. CPI, and then is there any information out there that helps to understand, is there a change in that trend, or are we going in a different direction? And so in terms of the broad trend, we've come a long way from kind of the 6% kind of inflation rates on core inflation back in 2022. It kind of came all the way down to about 2.5 earlier this year before all of the tariff noise, right? So that was that broad trend of what I'd call disinflation. And then with the tariff impact, the consensus economic forecast right now is for a temporary increase in core inflation in the U.S. to around 3 to 3.5, which we're in the midst of, and essentially that persisting into next year, and then declining back to around 2.5 by the end of next year. So that's kind of the broad picture. And then there is other data that you can look at besides the actual hard data. There's survey-based information. We see the ISM, for instance, has the manufacturing and services PMI. Within those, we always see the headline numbers, but within those, there's these prices paid subcomponents that actually correlate pretty well with CPI. So you can look at survey-based information. There's also a lot of alternative data, which we hear about. There's, for instance, private sector data that scrubs online prices. Or there are housing data that helps to understand shelter inflation. So when you put all of that together, what I'd say is that this idea of a temporary increase in inflation right now and kind of into next year looks to be intact. But there's still the stickiness in inflation that's out there. So getting back to 2% is certainly not in the cards anytime soon.
When I hear that and the fact that we're not in a complete dearth of information as there is, do we pay too much attention then to the monthly inflation? I know it's an important piece, but it really gets a lot of attention month to month to month, as if it's the end all be all.
For sure. I think there's sometimes a bit too much weight on it. But so you have to look at the broader trend. And we also have to keep in mind that even the official data often can be a very statistical exercise that has a lot of estimates behind it. And we're seeing that a lot, across a lot of different data points where there's a lot of big revisions later, or there's just questions around the data quality. So I think no matter what you're looking at, it's good to have a bit of a mosaic of information that you look at, and to be open-minded on newer ways of looking at things. And that's where alternative data. It's important to have a process that factors that into your thinking.
All right. Apart from that, we're into another earnings season. The big U.S. banks kick it off. We start to hear from their CEOs. J.P. Morgan CEO Jamie Dimon, he is warning about credit risk out there. Are you seeing the same signs of stress that Jamie Dimon is talking about?
Well, okay, so I think there's stress in the bond market broadly, and that you could get worried about when we have, concerns around inflation. I'd say from that perspective, when we look at just interest rate and volatility interest rates, it's pretty calm. The long-term inflation expectations are around 2%. So there's no kind of big issues around from a macro perspective. But from a credit perspective, I'd say it's been a very strong story of fundamentals for the whole year. Earnings growth has been pretty solid. And at the same time, corporations haven't needed to borrow a lot, compared to the amount of demand that there is for corporate bonds. So that supply demand is pretty positive for corporate bonds. I think where we're seeing some risks more recently, are some specific borrowers in the U.S. that were kind of in the subprime auto lending area. And for sure, that's we all remember the global financial crisis or other periods where those were of concern. I don't think there's anything systemic out of that yet, but I think it just goes to show that in any market, when it comes to credit, you really have to know who you're lending to and do your homework.
Okay, so that's what's happening in the markets, what's happening with the amount of information we have to try to figure what's happening with inflation. Of course, the Fed has to take a look at all of this, try to figure out where they are on employment, where they are on inflation. How does it set them up?
Yeah, so I guess what they'll first look at is what's the market priced in, because they've already been guiding the market towards rate cuts for a while and had the cut back in September. So as it stands now, the market's already fully priced in another cut in October and another cut in December. So that's already 100% baked in. And so there's not a lot that could probably derail that. But it's the path afterwards that gets a little more uncertain. Right now, the market's priced in, I think, almost 3 cuts to kind of this time next year in 2026. So it's more that uncertainty of, do you get all 5 of these cuts that are priced in from now till end of 2026? And that's where the data will have to guide it. But I think for the most part, with inflation, when I talked about inflation, it's sort of this known trajectory where we know it's going to be a little bit higher in the near term, but gets back to what's probably close enough to 2%, even if it's not exactly 2%. Knowing that the Fed has a dual mandate of stable prices, stable inflation, and also maximizing employment, they're more focused on that second one, where they want to make sure they're supporting the labor market. And with the kind of weak job data that we've seen recently, I think the Fed is set up to continue cutting, but not to anywhere below their neutral rate. I think they'll have to get towards their neutral rate around 3%. But with inflation kind of sticky, it's hard for them to have the case to go well below the neutral rate and be in a stimulative monetary stance.
So we put all this together. What's the outlook for the bond market?
Well, I think it's pretty constructive because, again, volatility in bond yields are fairly low right now because inflation risks have come down, and economic growth is basically not too hot, not too cold. It's kind of just right, and that allows for fixed income to provide kind of returns that are in line with their income level. So that's kind of mid-single-digit returns is sort of a good base case for fixed income. When I compare that to cash, in Canada, cash, income levels, cash rates have come down to only around 2.5%. So that's really barely above inflation here in Canada. So for fixed income to get mid-single-digit returns, and for fixed income to still provide an optionality where in a recessionary environment that's not priced in, you'll get probably high single-digit returns. That's a good sort of component to have in your portfolio where you have that income and that upside if things don't turn out the way the base case is right now.